Hey everybody, it's Chuck Barone. Wednesday, November the 8th, 2023, and here we go. Actually a quiet day, but a lot of interesting stuff to talk about today. The market's kind of just in a little bit of a holding pattern today, trying to figure out what in the hell's going on, and good luck trying to figure that out, because if they could, well, they'd be right all the time, and they're not, right? But anyway, before I get rolling here, let me take a second, welcome everybody to the show. As always, let you guys know how much we appreciate your support. We wouldn't be doing this show if you guys didn't keep showing up to watch the videos. Hit me up in your comments and questions. Anyway, markets today, kind of like I said, a flat day, not much really happening in these markets today. Stocks ending mixed. The Dow goes down 40 points today, falling 40 points to 34,112 on the Dow. The Nasdaq gains 10 points, 13,650 on the Nasdaq. The S&P up 4 points, 4,382. So as you can see by these numbers, the market kind of in a holding pattern today. I think we're going to see what happens tomorrow with this jobs data. Consumer credit report from yesterday came out. I got a little bit of information on that. That pointing to, consumers obviously in hawk up to their eyebrows. So the market's kind of mixed, trying to figure out where things are going. What's Powell going to do? He had a few comments today, and trying to get a sense of direction, very difficult. The bond market today mixed, a weird market today in the bond market, but it seems to be a weird market every day, right? The 10-year today falls 5 basis points. So you're sitting at 4.52% on the 10-year, and that one's really important because a lot of other interest rates, such as mortgage, credit cards, and other stuff, car loans, are based on this 10-year. And it spiked up. It looked like it was going to head well over 5%, had the market crapping in its pants. Now it's retreated all the way back down to 4.52. Now don't get me wrong, guys. I think that falling rates are a good thing, especially for a guy like me who is in a very interest rate sensitive business. But I just don't believe for a second this is final. They're going to bounce back up again. Believe that. I guess it depends on your point of view. Do you really believe that this inflation fight is over? Do you believe the Fed has done enough now to cool the economy enough to get inflation down under the 2% target? Do you believe any of this stuff? I got to tell you, they keep telling us how great the economy is doing. We read these reports, sure, jobs are good, businesses are hiring, but they're not really, again, you see the way wages are going up. So all these jobs, everybody churning all these jobs, it's creating wage gains, but it's certainly nothing that I would call significant or in any way dramatic. So it's everybody running on a treadmill here, and at the same time, everything going up in price. Now, they can say what they want about inflation, how it's, the numbers aren't going up as fast. They're still going up, and we're still sitting, when the number went up, 8% last year, and now we're going to add on, another 3% this month or whatever. This just keeps piling on and piling on and piling on. Where these prices, people are hoping prices are going to go back to what they call normal, what they used to be. Not going to happen. So it's never going to feel good, I guess, or as good as it did. Crazy. Anyway, so the bond market, the 10-year coming down, but at the same time, 2-year actually up 2 basis points today. So the inversion getting a little bit wider. Now we're back up to 42 points. It was really narrow for a few days, 14 basis points, I think. 4.94% for the 2-year up the 2 basis points. So, you got the longer term people buying those. Obviously, people selling shorter term. So they really believe the Fed's done. Only a 15% chance, 0% chance December rate increase, only a 15% chance in November. Really, what they mean by 15% is 0. So they really believe, the markets do, that this cycle of rate hikes is over. I don't buy it. The dollar today flat, still in a strong number, 105.54 on the index. No movement, still a good strong dollar. Gold and silver, however, not a good day for gold. Gold falling today almost 20 bucks, $19.20, sitting at $1,949.50 for an ounce of gold. Silver falls 9 cents, $22.53 for an ounce of silver. So again, strong dollar holding metals back, a lot of uncertainty, less sovereign buying, governments not loading up on the tonnages like they were. I think still gold and silver are good buys. I think they're going to move higher. I really believe $25 silver is going to be a wish it was back there someday thing, we'll say. And $2,000 gold, I'm surprised it's not there already. Oil today, wow, look at this, man. Oil comes down another $1.92, now sitting at $75.45 for a barrel of West Texas Intermediate. So the price is coming down pretty rapidly. We were looking at $100 a barrel. Now we're looking at $75 a barrel. Pretty big difference. Now I've been telling you guys, I've been right on oil. I've been telling you guys, it wants to trade between 70 and 75. It always, there's spikes here and there, but it always seems to revert back to that number. And here we are at 75 and change. I think we'll continue to drift down a little bit. We might get a bounce here or there, but that's where it wants to be, and that's probably where it's going to end up. The funny thing is, though, I don't see anything happening at the gas pump. Now, I watched the gas prices go up real fast when the oil was going up, but I'm not seeing them come down. Now that oil prices are really tanking, you're talking a pretty big decline from 100 to 75, right? No relief at the pump. Greedy piggies. Bitcoin today, down $139, 35,465 for a Bitcoin. Good strong number. And again, no news that I saw driving prices on Bitcoin today. But that ETF and several actual ETFs looming out there, giving a boost to Bitcoin, I think. And if those things actually ever really become real, if the SEC can figure it out and approve these ETFs, Bitcoin going to go higher, guys. All right, let's talk about news for the day. Well, I reported yesterday that we're going to get the consumer credit report. It didn't come in till late. I was reading this morning. Man, consumers are not listening to my advice, guys. I hope that the people that this report relates to are not viewers of this show, even though the viewers of this show are a very small percentage, obviously, of the population. Very small. But consumer credit just hit another record, $1.08 trillion in credit card debt. Wow, okay. So now credit card balances spiking year over year. So from last November to this November 1st, $154 billion in credit card charges. Largest increase year over year since 1999. So consumers going to credit cards way more than they should, piling on debt way more than they should. Rates on credit cards now over 20%. In some cases, much higher. Consumers are turning to credit cards in tough times, though, because it's super easy access to capital, even though it's probably the most expensive access for a good borrower. So, obviously, I don't know if they're actually using cards to make ends meet for food and gas. We see some of that. Or they're just making up the extras they can no longer afford with their regular money, with their regular pay, because prices have gone up so much so they can't afford the fancy dinner once a week or the night out with their friends, so that's what they're charging. I don't know what it is, but not a good sign. I think that before this is all over, we're going to see record consumer credit card debt, and all the other kinds of debt. And now following that, we will see record consumer bankruptcies as consumers take the most drastic step to shed this debt. I was reading today another interesting little tidbit for you guys. U.S. bank stocks today hitting an all-time low relative to the S&P 500. Bank stocks just getting smashed, caught in a rate whipsaw, right? So rates for so long, for so low. So what were banks doing? Borrowing at super low short-term rates, lending at still at super low but a lot higher long-term rates. That's the bank strategy, right? Borrow short-term, lend long-term. And that works great until yield curve inverts. Okay? So now you got banks actually losing their asses on every loan they make. And the worst part about it is, with the Fed raising rates the way they have, bank reserves, which are typically not sitting in cash, they're in bonds, getting smashed to smithereens. Banks in the U.S. banks, now sitting on over $650 billion in unrealized losses on their reserves, on their bond holdings that they keep in reserve at the bank. Can you imagine if they had to sell these bonds quickly? They're all Silicon Valley Bank. Bank of America alone has over $130 billion in unrealized losses. Wow. They're all going to end up holding these bonds. How many bonds you have to hold to have $650 billion in losses? So these trillions of dollars of bonds are going to be held till maturity. That way they can protect the principal there, right? But what it's going to be is a massive loss to all of these banks in what they call opportunity cost. Because what's going to happen is they're going to hold these loans long term with these crappy interest rates, and they're going to miss out on higher rates, better returns on other investments, and all different kind of opportunities, because this money is going to stay locked up for so long. Dead money is basically what we're going to have here, trillions of dollars of it just sitting there on underwater bonds being held as bank reserves. It's friggin' crazy, right? We had Powell out today saying, well, this is my favorite sentence of the day. He said, rate forecasts need to be flexible with the dynamic economy. Let's face it, guys, Fed economists and government economists have been missing the mark pretty badly on all of their forecasts. They've been getting pummeled. The biggest one that made me laugh was them saying that, because rates are so high, real estate prices are going to fall. Oops, that's the biggest failure they've had. And what's happening now is this has really worked out weird for the Fed, because ordinarily higher rates would bring real estate costs down because the cost of carrying them is so high. But because rates were so low before, no one wants to sell their houses, so there's no inventory. So you have supply and demand, simple economics. No supply, big demand, driving prices up when they should be going down. And here's the fun part. How big of a part of the Fed's CPI is real estate and rent? Huge part of it. And it lags. So these higher real estate prices are going to keep these inflation numbers higher for a long time. Not great news for the Fed. So higher rates are actually keeping real estate prices higher and driving them higher too, because no demand creates competition. Competition pushes prices higher. It's friggin' crazy, guys. Anyway, that's it for the day. We appreciate your support. If you could, please hit the like button. We appreciate that. It changes the algorithm around, gets our videos out in front of a few more people. We really need the help right now. As always, hit me up with your comments and questions. I'll be on today responding, so I look forward to speaking with you guys in comments. Anyway, that's it for the day, guys. We'll be back tomorrow to bring you the news you need. Until then, guys, take care. Thanks.